Okay, good evening, guys. So, without wasting much of our time today, we're talking about the market structure. You understand? So we can just having creating the demo account, like I said, which guys we should create. So we've linked it with our MT5. So the next thing we're going to be doing, like I said things are about to get real. You understand? So let me see if I'm sharing my entire screen. Yeah, okay. I'm sharing my entire screen. Let me optimize for the video clip and share sounds. So, okay. So now let's open to the candlesticks trading Bible, which the textbook will be using for today. So let's scroll to what we talked about candlestick before yesterday, but we were unable to have the class yesterday due to the nature of my health. So I hope you guys actually went back and did your research on the other reversal candlestick pattern, like I said in the other class. You understand? So today again we have less than 1 hour to go. So as we talk about market structure today, we'll be talking about some other type of candlesticks too. Because since we said everything works together in end to end. Oh. So now I'm trying to scroll to why this thing kind of far now. Okay, fine, guys. If you look at the candlestick Bible today, there are different exercises for the candlesticks pattern there. So now let's go to page page 50, page 51. So page 51, that's where they talked about the market structure, you know. So one of the most important skills that you need to know as a trader is the ability to read the market structure. You know, we said it about that the last time we had this class, ability for us to read this chart, since we all know that this chart is giving us or telling us a story, is a graphical representation of what's actually happening in the financial market. So one of the, as a trader, the ability you have to know is to be able to read the market structure. It's a critical skill that will allow you to use the right price action strategy in the right market condition. You're not going to trade all the markets the same way. You need to study how the markets move. You understand? We have different kind of markets. For instance, this is the virtual market, the one I said, like, what is virtual, that is not the financial markets. So this is the volatility 25, we have volatility 10. So we just have to pick some particular pairs and face those pairs. Don't forget we said we'll actually be using 4 pairs normally, or personally I trade 4 pairs, which is the Euro GPD, Euro GPD, GBD USD, GBD JPY, and Gold USD. You understand? And if you can master these skills when you open your chart, you will be able to answer this important question: what the crowds are doing, who is in control of the market, buyers or seller, what is the right frame and place to enter or to assist the market. Because if you actually notice when you enter the market and you see that buyers are the one in the action, you want to buy alongside with the buyers. You understand? So through your price action analysis, you experience 3 types of markets. You understand? We have the trending markets, the ranging markets, and the chopping markets. You understand? So in this chapter, in this section, we'll talk about every market and how to identify their trend. You understand? So now I said market structure. In this market structure chapter, you tend to know the trending markets, get your pen, the chopping market, and the ranging markets. You understand? So now, talking about the trending market, let's talk about the trending markets first now. The trending markets are simply characterized by a repeating pattern of higher high, higher low, or uptrend market structure, lower high, blah, 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 blah. You understand? Let me explain that. So now, for instance, I said we have 3, right? I said we have the trending markets. What again? We have the ranging markets and the chopping market. So let me start with the chopping market. So when you see a chopping market, you get out of that market because it means the market does not have a particular movement. You understand? And what we mean by a chopping market is the moment see something like this now, they can actually call it as consolidating. But a chopping market, because it's actually hard to understand, it's just moving in some pattern that we don't understand. Maybe it's the buyers or the sellers that are actually in the market for a particular period of time. You understand? So when you see a chopping market, that's a no-no. You understand? But when you see a ranging market, you understand? Let me explain what the ranging market looks like. You understand? So explaining what the ranging market looks like, I will branch a little bit about support and resistance or demand and supply. You understand? So now, a ranging market is a market that is the market was moving from a particular position. When it hit another particular position, you see when the market was started from position 0, when it hits A, it came back, and when it got to the position of 0, it came up again. The market starts ranging from a particular price. You understand? Let's say maybe the starting price of this 0 is maybe 5 naira. Then this A particular price line is maybe 20 naira. So when the price rose from 5 naira to 20 naira, it came down back to 5 naira. From 5 naira to 20 naira, that's an example of a ranging market. You understand? And that's actually another law of supply and demand. You understand? So we've not gotten there now. But along maybe today or tomorrow or the next class, so we're actually going to get there. You understand? So there's not actually going to be class tomorrow because we are starting the calendar routine effectively from tomorrow. You understand? So this is an example of a ranging market. Okay, so the market is actually ranging from a particular price, blah 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 blah. That's an example of a ranging market. So when it comes to the trending market is actually divided into two. You understand? We have the uptrend and the downtrend. Don't be confused. Everything works together in hand to hand. You understand? Sorry, the downtrend and the uptrend market. That is. So now, what do we mean by the uptrend? What do we mean by the downtrend? You understand? Now, very good. Now, may looking at the charts we have on our screen here. You understand? Just may looking at the chart we have on the screen now. You see, we can see where the chart started from. We can see the ending position. You understand? This is where the chart started from here, and it's ended here. Let's say it's ended here, around this place, or we can actually choose this place. So now, me picking from where I think it started to where it ended, I want to make it in a simpler form new. So obviously, we can see the thing went up. I don't know if you understand what I'm trying to say now. We can see that it was rising, yeah. It's rising, it was rising. So this is an example of what? An uptrend market. You understand? So there's something they can actually ask you a question. Maybe in the exam, you guys are actually going to write out. What are the validations of an uptrend? Or they'll tell you that, how do we know that, okay, fine, this market is in an uptrend or downtrend? You understand? That's when we'll come up with a validation of higher highs or higher lows. You understand? So what do we mean by the higher highs and the higher lows? We've actually explained the choppy and the ranging market, guys. So let's spend our time on this downtrend and uptrend. You understand? So I know somebody will be like, this choppy also looks like the ranging. Yeah, it's always look like the ranging, but you get more clearer picture in ranging than in choppy. You understand? Choppy are always coagulated, like always close packed. Barely understand what actually wants to happen next. But that of ranging can actually make a decision. You understand? So now let's go back to the trending markets we're talking about, which is the uptrend. So now, like I said the validation, they might ask you that what are the validations of an uptrend. Now that's where the higher high, also known as HH, kicks in. You understand, guys? And the higher low, which is also known as HL. That's for the what? That's for the uptrend. So for the downtrend, we have lower high, lower low. You understand? So now let me explain. Now, I wish I could have actually explained the demand and supply before this. But since we're actually following the textbook, let's go. So now what they mean is by this higher high and higher low is now we said this is an example of an uptrend market. We said this is an example of an uptrend market. So now I said the validation of an uptrend market is the creation of higher highs and higher lows. Isn't that right? So now let us find our higher highs and our higher lows. So we said our higher highs will be what? Will be HH, while our higher low will be HL. You understand? So now, since this is an uptrend market, so any market, let's start from here. So this is a low. You understand? So this will be a higher low. Since this is a low, it will be a higher low. The high will be a higher high. The high will be a higher high. You understand? So now, let's look for another high. Let's look for another high that is higher than this high. This is a high. You understand? This is a low. You understand? So now, me looking at this is actually taller than this. You understand? So this means this is another higher high. Since it's an uptrend, so there will be a creation of new higher highs and new higher lows. I don't know if you understand that part. This is a low, so let's use this as the low. This will be another. This will be another. Okay, let's create high. Let's use another high. Another high. Yeah, we need another high, guys. Another high. Since in our uptrend markets, there will always be another higher high that is greater than the previous higher high. You understand? So for lower lows, there will be for higher lows, there will be another higher lows that will be greater than the previous higher low. So let's use this. Can you see higher low? Higher low. Sorry about that, guys. Higher lows. Higher lows. Can you see? Those are the validation forward of an uptrend. You understand? That is creation of higher highs and higher lows. Please know what I'm saying now, because when we get to the real advanced, because this is just more or less like beginner. It's not actually hard, but the main thing actually said you should know what we are saying now is so that you will not actually get confused. Yeah. So that's that about that, guys. So I'm looking for where we'll talk about downtrend. Okay, I've seen one we'll use as a downtrend. So that's validation for what? Uptrend. Now let's go to downtrend markets. You understand? So now let's start from let's use from year to year. You understand? So from year to year, you understand, it's actually a downtrend market. You understand? That is, if I'm to pick my eye, this is the eye. Let's forget about this part that actually happened. You understand? Okay, let me use something like this now. Okay, yeah. You can see this is actually a downtrend market because it means that if the market should start around this place. Sorry, guys. I'm having this bit of code. As if the market should start from this place. Come on. And it ends here. So definitely, it means that the market is going down in a bearish movement. So this is a downtrend. So now I said the validation for lower higher uptrend are higher highs and higher lows. So if it's going to be downtrend, reverse is actually going to be the case. You understand? The validation will be what? The validation will be lower high and lower low. Do you understand? So now, so if you go back to your book, you actually understand what I'm trying to say. I'm sorry, I'm trying to say. You understand? So after this definition of uptrend, and that will lead us to support and resistance. And I would pledge you guys to just stay very attentive and listening very well. And we'll get to that because After that, we'll actually talk about supply and demand. Well, I won't even talk about supply and demand now. We'll talk on how to trade with just the pure support and resistance. Then later, I'll talk about the supply and demand. You understand? So I want supply and demand to be a day course on its own. You understand? I want to be a day course on its own. So when we talk about support and resistance today, and how to trade with just support and resistance and the candlestick, those little things, alongside fundamental, which I've taught you, how to combine just those three alone to trade. You understand? Yeah. So we'll talk about the demands, the zones, starting from Monday. You understand? So now the validation, I said the validation for the downtrend will be what? All this you actually have to know it because you might get to a time you actually explain or reading any book so that you won't get confused. You understand? So I forgot to say something the other time. So there are two movements. You understand? In the validations of trends. You understand? For instance, it's an uptrend. You said it's an uptrend. You understand? So now there are two movements. You understand? So don't let me convince you. Since the market is moving an uptrend market, you understand that the market is going up. So if we have a chart that is like this that I'm drawing, normally this market is actually going up now. The higher high, this is the higher low, this is the higher high, this is the higher low, this is another higher high, this is another higher low, this is another higher high. You understand? Now, any movement, since the market is going in an uptrend, are you listening, guys? So any movement going in that direction of that uptrend is called what? The movement going in that direction of the uptrend is called what? It's called the impulsive move. Can you see it, guys? Then the one going against it, that is normally we know it's actually an uptrend market, but the market is trying to sell or pull back. You understand? So this is actually uptrend markets now. So any market going up, it was impulsive movement. The one coming down is what we call corrective or retracement. Corrective or retrace. Please, can we mute our mic, please? So now this will be what? This will be corrective movement or retrace. Let's know that. Let's go back to our example of downtrend. So now let's put the validation of a downtrend together. I said you have to have lower high, lower low. So let's say this is the lower low here. This is the lower low. And let's create another. Let's create a lower high. Lower high. Okay. Lower high is low downtrend. High. Sorry, uptrend. Higher. Downtrend. Lower. Don't get confused. So now this will be another lower low. Any low, you can use this. You can just try and make them feasible. You understand? So this will be another lower high. Or let's even label all the lower high. Lower high. Lower high.
Have you shown them? Don't do it.
Lower high.
What is this?
Lower high. See. You know why these are very necessary? Let me explain why it's very difficult to you. And I'll show you why. You've not actually gotten there, but you can actually, where is our lower low? Let me visit it. You know why it's very necessary? Can you see? I've actually labeled it. These are the validation for this kind of movement. So now I said for those, like just like how I said the other time that there are two movements, there are two names for all these movements. Since the market is actually going in a downtrend, that is in a downtrend movement, that is this is the lower high, lower low, another lower high, another lower low, another lower high, another lower low. So any movement going in direction of the trend in a downtrend movement. So any movement going in the direction of the trend, since the market is actually going in a downtrend in a bearish movement. So any bearish movement like this, these are the bearish movements. They are selling. Any selling movements, even these tiny ones, any selling movement are called impulsive movements. Any movement going in the direction of the trend is called the impulsive movement. You understand? It's good to trade the impulsive movements. It's not good to trade the what corrective movements. What I mean by corrective movement are the one going against the normal trend of the market. So those are the one we call the what I call the other term corrective, or you can say retracement. You understand? Let's digest this thing little by little. You understand? So do we understand that now? So I was saying the other time that the reason why this is actually very sweet is they call this thing validation because when all these things occur, when it starts to occur, it means that the market actually wants to go that particular trend for a particular period of time. But when things start to change, that maybe there's no new creation in higher high, or there's no new creation in lower low, or there's no new creation in lower high, or there's no new creation in, you understand? That means that the trend, or let me say the direction of the market wants to change from maybe downtrend to uptrend, or uptrend to downtrend, depending on what was the initial trend of the market. So now a very good example of what we have here now, you understand, was the market coming from the downtrend already, you understand? And when it came here, when it actually came here, when it came here, we are having series of equal lows. We call them equal lows because they are equal. Instead of it to create another, instead of to create a another lower low, you understand? There are equal lows. Then the next thing was like it came out. We thought it was actually an equal low, a lower low. You understand? But getting there, let me now show you where it's actually okay. So if this was a lower high, definitely this would be another lower high, right? So it's another lower high. Let me copy it. You understand? But in this scenario now, if you notice, you will see that ever since we've been drawing this thing, we've never seen a lower high, a new lower high, taller than the previous lower high. It has to be shorter than the previous lower high. So for this case to actually happen, it means that, okay, since the trend doesn't want to obey, that is the validation of downtrend of this downtrend doesn't want to be obeyed again, which is that another lower high that was supposed to be a lower high is already taller than the previous lower high. Instead of to be like this, come slantly. It's actually like it's already bringing its mount up. So definitely there wants to be a change in the markets. You understand? So as you can see, there was a new. Okay, we actually not use this one because maybe it's not kind of feasible. Now let's come here. This was our last lower low. Can you see now? This is actually taller than this. So definitely, since we have a high, let me see this. Since we have a high that's actually taller than the previous high, so that means that the market is changing from this downtrend to uptrend. And can you see that the markets came here and boom, it's already going up, going up, going up, going up, going up. So can you see the validation is actually going up too? The higher lows are always higher than the previous. Immediately something like this happened again, that is this higher low. The main reason why this higher low didn't actually go beyond this one is because once it go beyond this one, it has to start coming down again. That is, that's change movement from the bluish movement it's trying to make to bearish again. Do you understand, guys? So these are how just the validations work. You understand? So all these things alone, if you're actually using one of all these things alone, it's actually okay to satisfy you. You understand? So without wasting much of our time, let's go to support and resistance. So call it a day for today. You understand? So now talking about support and resistance are like the sound. These are something that actually push the market's direction. Support and resistance. Understand? So now, this market's getting here. You understand? And tend to maybe change direction. It's not just didn't just decide to go down. There's something about that particular price, that particular line here that pushed the market down. You understand? So sorry about that. Anything that actually pushed the market from a bluish movement to a bearish movement is called a resistance. You understand? So you mark them out like this. Let me do something we've not actually talked about. Resistance. You understand? Something happened here which made the market change from a bullish movement to a bearish movement. So, and I might as well just talk about the zones today too, because it's more or less like the same thing. But I'll not just talk about the laws. So this is another resistance, another resistance. This that like you understand what I'm trying to say now? At least it was something that actually pushed the market down here. You understand? So now it's something that was literally pushed. It's something that actually literally pushed the market up here. You understand? And same thing here. Something was, if you actually switch to a higher time frame, you will see it was something that actually pushed the market up here. So something that actually pushed the market up here. You understand? So anything that changed the direction of the market from a bearish movement to a bullish movement is called what? Support. You understand? So now let's label our stuffs, right? So like I said, anything that actually pushes the markets down from a bullish movement to a bearish movement, that is from buying movement to selling movement, is called resistance, right? Okay, but let's design them with one. Understand? So R. So let's design them with R. Sorry about that, guys. So support anything that actually push the market from a bearish to a bullish market. S. This is a S. Another S here. Okay, this is the R. So you can call this R2, but for our time, let me just name everything R1. R. Same thing applicable to everything. Everything. So same thing here. S, 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 S. So they are just support and resistance. They are just lines. You understand? So now, a particular line. Now let me now explain in English now. A particular point in which the price of the market hits, and at that particular point tends to be a change in direction of the market, is what we call the support and resistance. Now, if it changed the movement from a bluish movement to a bearish movement, it's called resistance. And if it changes from a bearish movement to a bullish movement, which is example of here, it's called what? The support. Do you understand, guys? Now, I know it might actually look a little bit chunky poppy, but when we get to the aspect of the supply and demand in proper, which is next class, you understand this thing very well. So now let me kick this thing in. Let me kick this thing in now. I won't say much about that. Supply and demand. Remember I said the major things that actually move the market is what? Our supply and what? And our demand. So having knowing this now, what is our supply or our demand zone? You understand? Now, before you can actually spot your supply and demand zone, you actually have to know how to spot your support and resistance. Because These are the collections of supports and resistance. Now, the collections of all the resistance you have at a particular area that they're actually close to each other. Don't forget that word. They have to be close to each other. You understand? Before you can actually call it a zone. Because you're actually going to do that like that. Because this is resistance, 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 this is resistance. If you're trying to now pack everything together like this, what do you want to trade? So they have to be closer to each other, like very, very close to each other. And it will actually give you the precise. And I'll make an example and the reason, psychological reason why it's actually a little bit okay to use the supply and demand zone than just focusing on the supports and resistance alone. You understand? So now the collection of all resistance, the collection of resistance is called collection of all resistance to get a zone is what they call the supply zone. You understand, guys? Why the collection of now? Don't forget I said they have to be together. So this is support, right? This is support. So let's try and pack from here because this is actually a little bit kind of far. But this is close, close, close. So let's try and pack like this. Now, you can call this zones because we have collection of supports, support here, support here, support here, support here. So you can call this what? You can call this a demand zone. Don't forget that I'm actually going to talk much about this again in the next class, but I'm actually going to stop here. Just definition. Understand? Now, let me go to the psychological meaning why I said it's actually okay for you to use the supply zone and demand zone compared to support and resistance. Now, let me ask you a question. If you actually have a particular shop, you understand, and you were to say they will give you maybe 100 million of naira just for you to answer a question, right? You understand? Maybe the name of the shop is Daddy and Mommy shop, for an example, you understand? And maybe there was a time these people, they actually used to open around 10:30 a.m. in the morning. They open around 7:30 a.m. in the morning. They open around 6:30 a.m. in the morning. They open around 7 o'clock a.m. in the morning. You understand? And maybe an analyst came to you and said, okay, fine. Can you tell me when I can actually come to this shop and I'm actually going to see them that they open in this shop? What are you actually going to say? You have to give a correct answer. A correct answer that actually has to take all these things together, which will make you right. Now, say the answer in your mind. I'm giving like 3 seconds. Have you done that? Now, I will say just come in the morning. You understand? And the reason I'm saying come in the morning is because this is the morning, this is in the morning, this is in the morning, this is if I give them a specific time to come, it might actually be if I give them 6:30, they come by 6:30. It's possible for them to come by 10:30 before they open the shop. You understand? If I tell them to come around 7:30, they might actually open the shop around 6:30. Okay, fine, that's still good. So if I tell them to come in the morning, I'm still right. Anytime they come in the morning, I'm still right. So the same thing actually applicable to this supply and demand zone. You understand? So it means that anytime they come, very funny thing is that they can actually come around, let's say 10 o'clock, 6:30, 7:30. They might actually come around 9 o'clock and they'll meet them in the shop. You've not actually done that before. But because I've actually said in the morning, that's still actually guarantee my safety. You understand? Same thing applicable to all the resistance. Now, my joy is assuming this market actually fall out of this zone. You understand? It might actually come around this particular zone later in the future. It might not actually be this particular line. It might not actually be. It might be between this line and this line, which is around this place. You understand? And the market will actually change the direction in price. You understand? That's actually advisable to use zones because zones a lot happen in the zones. Zones are the collection of resistance. You understand? Or and support. So that's that about that. So looking at the next thing we saw on how to draw a trend line. So from how the names imply trend line. Don't forget we actually talk about the trading market, which is the uptrend and the downtrend. So before you can actually draw. So before you can actually draw trend line, you actually have to do direction what you actually want to draw. You understand? And so not to be mistaken. I'll say something now. There are two things that actually look like trend line. We have the channel and we have the normal trend line. So I would not like you guys to confuse this thing. I will differentiate it. Very easy to differentiate. You understand? So looking at the examples here now. So how to draw a trend line is more or less like, okay, let me pick this up. These are uptrend markets, right? So now all I have to do is just pick one or two. You can add as many as trend line as possible as you want. So now this is a trend line. The trend line sends a which that I will draw, and when I draw, I make sure it actually picks. This is actually uptrend. So if I'm drawing a trend line, it has to go up. So it has to touch at least two tips, and when you touch these two tips of this line, there has to be a bounce back in price. So I can actually make use of that to predict the next movement. Okay, fine. Anytime the market is that line again, anytime there will be a bounce back. And can you see when it actually happened here? When it actually touched this line, there was a bounce back. Looking at it alongside the candlestick, I actually said, I said there are other confirmations that you actually have to look and actually using the candlesticks. So now, looking here now, I can see that around that particular zones too, you can see the reversal candlestick actually forming, which we discussed in last class. Now, can you see? But that thing is like when you're actually going to pick your trend lines, always make sure that the lines, the candlestick, your trend line, the lines. I listen, please mute. Always make sure that your trend line is always picking, always touching the candlesticks. There is a reversal candlestick. That's another thing to be sure on how to do a trend line. You understand? And like I said, you can actually draw as many as possible trend line here. You can actually draw. You understand? So, because for instance, now, not to get you guys confused, I can still pick another trend line around here. You understand? Yeah, it picked 1, 2, and I started bouncing here. There was change in direction until it came here and no longer expected it. That doesn't mean actually going to expect it for long. At least after 3 bounce, you should be expecting a breakage. And you can actually notice after the 3rd bounce here, it broke it as well. You understand? So that's that about that, guys. So that's how to create a trend line. You understand? So this is a trend line. So what is the difference between a trend line now and a channel? You understand? So now a channel is something like this that even after you draw the trend line and it actually pick like 2 or 3, it was coming like this, it was coming like this, it was coming like this, it was coming like this. You understand? You don't let me make it. I don't want to make it in a good pattern. You can call this a trend line. Because actually obeying one movement. You understand? Which is the downside movement. You understand? That is believing that when the price is this lower trend line, there will be a change in direction in price. But a channel, but the fact that these actually are not actually in a straight, let me say, pattern like that of the downtrend. Can you see? It only touches twice. These were not touching it. You understand? So that's why I can this is a trend line. But once it's a channel, everything has to move in a regular pattern. Okay? Can you understand what I'm trying to say now? So it has to be like it's more like a ranging way, vertical upward ranging market. You understand? So it has to come here, it's here before it's come here. So this is a channel. While the other one is a trend line. So thank you guys. If you have any question, you can actually drop it in the group. Our time is up. Thank you very much. Make sure you actually join the next class. Like I said, the real deal is about to begin. So thank you guys. Good to have you guys around.